For those of you that don't know me, my name's Alex Harvey. I'm a portfolio manager and investment strategist in the team at Momentum here in London. And I'm going to talk to you today a bit about how we bring our manager selection and our portfolios together into the strategies and the funds that that you use for your clients. So, brief agenda. I'm just going to go through a few different sections here, and to bring it into reality and put it in perspective, I'll sort of frame it very much around some of the recent performance that we've had in markets, and then talk a little bit more about how we, as I said, it's very much probably about the construct rather than specifically about the managers themselves. You've heard a lot from the managers today, continue to do so, and very much the sort of bottom-up quality that comes through. So I'm going to talk about a little bit about the construct and somewhat theoretical, but with practical implications. So setting the scene, if you like, the year to date, or the year to the end of June, actually, a first half that is certainly marked with very disparate performance. And some big drawdowns as well. I show on the left-hand side here, this is the S&P returns year to date. Those shaded grey lines are the discrete yearly performances for the last 50 years of the US market. And on the right-hand side, 45 years worth of US Treasury returns. And you can see to the end of June, at least in both of these markets, that was the worst performance that you've seen, pretty much for half a century. But it wasn't all bad. In commodity land, and Gustavo mentioned it in the previous presentation, we've had some very high returns, at least in the first part of the year. And you can certainly see on that chart towards the end of February, the invasion of Ukraine, and that sudden spike in commodity prices. Equally, Gustavo spent some time talking about the dollar and expectations there, or the reality of what's actually happened there. And again, to the end of June, you'd had roughly almost sort of 10% appreciation in the dollar. That's the DXY index, which is the dollar against its sort of major peers, particularly in the developed markets. Interesting to note, actually, that equities, bonds, commodities, on average over time, they've all had a positive return. But the dollar index, is actually pretty much flat through time. So we do go through these extended cycles of, strong performance and then weaker performance. But in currency terms, we tend to take the approach that it washes through over time, and that's one reason that we don't take, very explicit or strong currency views within the portfolios. So for a 60-40 portfolio, that sort of basic construct of equities and bonds, that's what we've seen in the first 6 months of the year. Again, compared to the previous 50 years, it's almost twice as bad as anything we've had previously. So why am I showing you this? Well, it very much talks to what you need to think about in terms of portfolio construction, going beyond simply the equity and fixed income. And depending on that relationship that's held well for 20 years plus now, that negative correlation between bonds and equities. I show here the 5-year or 60-month rolling correlation between equities and bonds, and we've just moved back into this period when we've got a positive correlation between the two. Very sort of macro-driven, pushing up the bond yields and inflation, and that has given sort of fright to risk markets, and we've had that re-rating as well. So seeing those two move together. But, as you can see at the start of this chart and in other periods as well, that's nothing new, and we could be in a period now when that, continues for some time. So we need to think about how to guard against that. So this is a rather stylistic representation, I guess, of what we're looking to do in the portfolios. The bottom half of the chart shows a sort of drawdown experience, with a basic 60-40 portfolio on the left, and then our outcome-based investing approach on the right-hand side. There's several levers that we use in order to, increase the probability of success up the left-hand side. that success being, achieving those outcomes that we set out to to achieve and beat in our portfolios in that outcome-based investing approach. So very much optimizing the strategic asset allocation, extending the opportunity set, which we'll talk about a bit more. There's tactical asset allocation, which I won't go into too much today. I will talk about some style blending and manager selection as well. But each of these layers, when you add them into the portfolio, not only are you hopefully improving the return prospects, but also increasing the diversification benefits that you get through that construct. So moving just beyond that sort of basic 60-40 construct, certainly just adding in several more asset classes, real assets for one, which has been a major sort of shift in, I'd say, our asset allocation over the last sort of 12 to 18 months. Alternatives, which we'll touch on, and you heard from Fred Ingham yesterday at Neuberger Berman. That's an important part of the portfolios and uncorrelated returns. And cash, which is starting to get a positive yield again now, and equally gives you that sort of option value to buy back in after markets have sold off. Something we've not done a lot this year in particular. 2021 actually was more buying the dips. We felt the backdrop was still constructive after COVID last year, but this year the economic backdrop has shifted a bit, and we've been a bit more reticent about buying into that. So cash levels, somewhat high today compared to the longer term. Adding another layer to that, though, certainly the sub-asset classes, you can break down, equities obviously into regional equities. You can break down bonds into credit or emerging market debt, for example. Each of these additional sort of levers adds a new layer of diversification in the portfolio. And for example, within the equity space, I've just highlighted two at the bottom there. That could be Japanese equities and emerging market equities, for example. We heard from Ashish yesterday at Ikea. They have a slot in the portfolio within that emerging market construct. And then I guess the final piece of that construct is essentially the multi-manager piece, and introducing different styles and different managers into the portfolios. This is itself actually is not stylistic. This is actually a sort of representation of the Momentum Diversified Moderate Fund as at the end of July. So each of those blocks is actually an allocation to an investment asset class or sub-asset class or manager or style. And that's a sort of universal, I call it the universal chassis of our approach. Doesn't matter whether this is a UK fund or whether it's a South African fund or in the offshore market as well. We have this sort of universal chassis approach to our portfolio construction and asset allocation. And then jurisdictions, require sometimes some tweaking at the manager or the solutions level around the outside. But broadly speaking, this is a template that we can use across different jurisdictions at Momentum. So actually just putting some numbers to this, I've got the return across the top, risk, and the risk-return ratio, which is the return divided by that risk. It doesn't necessarily stand to reason that returns will always go up by adding more asset classes, or necessarily maybe that the risk would go down. It depends. But what I would expect to see, and what does hold here, is actually the improvement in the sort of efficiency of taking risk within the portfolios. And this has been done, I've looked back over 10 years, using that construct shape and just pushing it back over the last 10 years and rolling it forward for each of those different constructs to get the return and risk from that. And there has been, an improvement. I would expect the similar going forward. We've heard from speakers about, an environment of heightened volatility, which should prove a better hunting ground, a better opportunity set for active managers that arguably, have had a tough 10 plus years from this wave of stimulus that has come through, the tide that has lifted all boats. And as that slowly gets withdrawn, you will see more dispersion, more active opportunity. So I'd like to think that, that outer wheel again will be, ever more important, particularly compared to the 60-40 construct. Just going back, I won't dwell on this too long, but in terms of incremental risk, I mean, obviously there's a diversification benefit that comes with these portfolios. I loosely termed them sort of level 1, level 2, level 3, as we added a sort of concentric wheel. And if you look at the additive risk of each of the underlying asset classes, which are those little yellow bars, you probably won't see the names at the bottom. But if you add it all together, without any diversification, you probably come to sort of around sort of 12 or so %. But actually, the blend and the diversification benefit, pulls that back into to about 8. This is defining risk as standard deviation. There's different ways to define risk, in terms of true impairment of capital loss or mark-to-market drawdown. We'll talk more about that. But just in terms of the sort of statistical standard deviation, you can see the improvement there. The chart on the right, again, it could be sort of stylistic and representative, but that's actually the real numbers. And thank you, Lorenzo, for helping me with that. But you can see how the efficient frontier there has been pushed out as you increase the asset class breadth in the portfolios. So how does this impact drawdown? Because that's what it's really about. And with outcome-based investing, investors will not reach their outcomes if they don't stay the journey. So it's very important. We heard from Paul yesterday talking about loss aversion and how investors feel the pain of loss, more, much more than winning for a similar amount. So trying to manage for the drawdown, trying to manage investors' drawdown risk and manage their expectations around that is crucial. Because if they have a bad experience, they're more likely to sell at that worst point, the point of most pain. And soon after that, you can probably bet that the markets will rebound, and that will all be missed out on. So in order to reach those goals, you have to stay the journey. And it's like baking a cake. You have the recipe, you put the ingredients in, but if you take it out too early, the cake will not be ready. So you have to give it time. Here, I've shown in the dotted line is the Msci World Index. I've got a 60-40 portfolio as well, and this sort of level 3 total construct. I'm showing this. I did a few different sort of drawdown experiences over the last sort of decade or so, but here I'm just showing year to date. And from the start of the drawdown, which is pretty much the start of the year, or the very end of last year, through to the bottom. Which was about the 17th of June, when we saw a bit of an uptick, and we've since come back again. But that's the experience that you've seen. So a decent outperformance just from that asset class breadth and diversifying the asset class selection within the portfolio. Now you've heard a lot from the managers today. So I'm going to talk a little bit about that and how we bring them into the portfolio, how we blend them together. I like this chart a lot. We call it Blend is Your Friend. And this goes back 25 years, showing the cumulative outperformance from 3 of the well-researched and well-documented investment styles, certainly which Vilma was talking about earlier. We've got global value, global momentum, and global quality. And there's a very simple, 1/3, 1/3, 1/3 investment into each of those through time. And you can see each of them individually quite volatile. Well, I guess the first point to make is that they all have a risk premium, that they have an outperformance that they've achieved versus the index. That's an excess return. So all of them outperform over time if you can isolate that factor and harvest the risk premium. But the profile of how you earn that is very varied and very volatile. And we think timing those stars is a difficult thing to do. Hence, this notion of blending and not taking too much risk, not throwing, all your eggs into the growth basket, because when value does come back, as it did sort of 18 months ago, it can be very sharp. And what you see, obviously, is the thick red line is that blend, and you get a much smoother return through time. You still retain all of that outperformance, all of that excess factor outperformance, but it comes with much less volatility. So this is embodied very much within our global equity fund and within the sustainable equity fund as well, very much using these style drivers, both fundamentally and systematically, to create a global equity solution. If I translate that portfolio into a sort of drawdown profile, then you see this chart up here. The gold line, which has really been drawing down since post the crisis, is value. That's global value. And while it has had a bit of a rebound, it's still very much underwater post GFC. And the others less so, but equally, they do. They have that risk. The green shaded area is the blend. So again, managing for clients' expectations or managing for the drawdown and trying to reduce that pain can be achieved by blending together these different investment styles. And then our manager selection around that, we will take a high conviction view in terms of growth. You've heard from Mark Baribeau yesterday in the Jennison strategy, which is a very high conviction growth strategy, and then also for Hotchkiss and Wiley, which is value, and also I can think sort of Contreras as well, which is probably one of the sort of deepest value managers within that. So as well as mixing the styles and blending the styles, you're also blending those alpha streams together as well, which again will add more diversification, not always more return, but eventually it sort of comes through. And by blending them, it allows you to take an investment to a particular asset class or style that in isolation just may be too risky. Manager selection is key. This again shows since the start of the year, this is the Ikea Global Emerging Markets Fund run by Ashish Swaryap and his team from Ikea, who spoke yesterday. Very much that focus on quality and stewardship and sustainable long-term returns. And you can see how in a period of risk-off sentiment and a lot of pain for emerging markets, how that portfolio, it's not being able to avoid the effects of that completely. Nothing but dollars and some energy would have done that. But they have been able to soften the blow. And that's crucial, again, within the construct. Fred spoke to us about partly about the fund that they run, the Uncorrelated Strategies fund, but probably more so about the underlying strategies. He mentioned, orthogonal returns, which are effectively, sort of statistically independent returns that you can get from harvesting those hedge fund type risk premia. And again, we put this in our diversification bucket. Diversify your diversifiers. We don't just own bonds. We don't just have treasuries. And that's been a really important driver of returns, as it was, and diversification, as it was also, I'd say, in COVID in March 2020 as well, when the strategy performed well. Also within that bucket, just to mention, something like Chinese sovereign bonds, which we started allocating to in December last year. Again, a little bit down this year, but nothing like what you've seen in US treasuries. And, it helps just build out that diversification bucket within the portfolios. Property and real assets, shine a light on there, just have a little look. I guess prior to our businesses coming together with Seneca 18 months ago, we were investing in a couple of investment trusts within the portfolios that we manage. And given the additional resource and knowledge and skill set that came with that acquisition and using the IP of the team there, we've been able to sort of build out the blend that we use in portfolios. Within the moderate fund, again, I've looked at this and taken the shape of the portfolio and just shown that sort of year to date. And you can look at any of the individual trusts that we have in there. And I'd point out that we don't have any open-ended property funds. It's not a model that we think is appropriate for in a liquid asset class, but investment trusts are good for that. And each of these, home REIT, we heard from Gareth Jones yesterday telling us about what the home REIT strategy and what they do. We could have had, individual stories from these other ones as well that are all quite individual, doing their own thing, specializing in different sectors, and each of them on their own. Well, I guess the pleasing thing to see is that it's done well. Each of them have done well, and collectively have done well. But again, they do move around. They've got a bit of volatility there. And by blending these together, we can dampen those offsetting, return profiles, and we get this, much better sort of blended return there. And I just highlighted on there in the sort of gold bar at the bottom. That's a passive strategy in listed real estate stocks, and you can see that we've meaningfully sort of outperformed by investing in more active strategies there. This chart here shows the same managers actually, but just in terms of the risk and return profile. We've got the 5 trusts up on the right-hand side, and then the passive index at the bottom, which has both underperformed. Yes, it is lower risk than any of the individual trusts, but when you put it in a blend together, you retain a lot of the outperformance, or a lot of the upside, I should say, but equally you're reducing the risk of that construct. And so it's much superior to just a passive investment strategy. I call this one, yes, the benefit of foresight, not hindsight. And what I've done is I've taken that level 3 portfolio, that broader construct, 29 sort of sub-asset classes in there. And over the last 10 years, I've said, well, if I knew at the start of the year which asset classes were going to perform the best and which ones are going to do the worst, and I rank them, and then I overweight, the best performing sub-asset classes the most, and I underweight the worst performing ones the most as well. What would happen to the profile of that portfolio or that construct? And you can see here, obviously, the actual sort of return would be better, overweighting the good performers and underweighting the worst ones. So we can see that as expected. And on the right-hand side, you can see that additional return in the light blue bar. But actually, in terms of risk, there's pretty much no difference between those portfolios in terms of statistical risk. 8.1 versus, they're both 8.1. And I think the message here really is that you have to take risk in order to get return. There's no, if you sit on the sidelines, you're not going to participate. So it's important. And you can manage for those risks in different ways, and that's part of what we do in our portfolio construction and optimizing the portfolio allocations and the asset allocation. Huge amount of work goes into that, which we will have probably spoken with many of you, separately around that. But in terms of, how the profile would look if we draw that down over the current year to date, the performance of that, perfect foresight portfolio wouldn't actually be a lot different today. That's overweighting the best asset classes and underweighting the worst. Marginal outperformance, but a very sort of similar drawdown profile that you will have had. Yeah, just to wrap up, and I guess revisiting on those first slides, I had that 60-40 construct. I put overlaid on top of that sort of multi-strategy, multi-asset wheel construct to look at what the performance looks like year to date, and just overlaying that against the backdrop of the 50 odd previous years, and you can see that's had a much improved sort of drawdown profile. And as I said at the beginning, my expectation would be, as liquidity and stimulus slowly is withdrawn, the pace of that withdrawal may or may not reduce should the economy move into or roll over into more contraction. The pace of that withdrawal may slow, but ultimately it will be withdrawn, and I expect dispersion of returns and dispersion of asset classes to increase. So the message really is, to continue to have, very broad asset class selection, and we populate that again with, sort of deep, active managers within the portfolios to, effectively get what is the only free lunch in asset management, which is diversification.